Many investors dream of passive income, but the idea of waiting 3 months for a dividend check can feel agonizing, especially when you're just starting out or managing a budget. That's where monthly paying exchange-traded funds, or ETFs, become incredibly appealing. These aren't just any funds, they're strategically constructed to provide consistent cash flow, making them ideal for budgeters, retirees, or anyone looking to supplement their existing income. But how do they achieve this monthly payout, and what makes them different from traditional dividend stocks or bond funds? The secret often lies in their use of sophisticated strategies, primarily covered calls. A covered call strategy involves holding a stock or a basket of stocks and simultaneously selling call options against those holdings. When you sell a call option, you receive a premium up front. If the stock price stays below a certain point, the option expires worthless and you keep the premium. If it rises above that point, you might have to sell your shares, capping your upside, but you still keep the premium. This generates a consistent income stream from those premiums, which the ETF then distributes monthly to its shareholders. It's a trade-off. You sacrifice some potential capital appreciation for enhanced, reliable income. Now, when we talk about starting with just $3,000, it's crucial to set realistic expectations. While $3,000 is a fantastic starting point for building wealth, a 10% annual yield on that amount would generate roughly $25 per month. While that might not cover your rent, it's a powerful psychological boost and a tangible step towards financial independence. It allows you to see the immediate impact of your investments and fosters a habit of saving and investing, proving that even modest capital can start working for you. This monthly compounding effect, whether through reinvestment or supplementing your cash flow, is what truly sets these funds apart and makes them a compelling option for a wide range of investors. Understanding these core mechanics is vital before we dive into specific funds, as it helps clarify their risk-reward profile. Having stayed this long, it's obvious you are getting value from this video. Would you mind encouraging us to continue educating you by kindly subscribing, sharing, and liking this video? Come on, it costs you nothing at all. Let's kick things off with JP, the JP Morgan Equity Premium Income ETF. This fund has garnered significant attention for its impressive yield and relatively stable approach to income generation. JP aims to deliver a significant portion of the returns of the S&P 500 while reducing volatility and providing monthly income. How does it do this? Through a unique strategy involving equity-linked notes, or ELNs. These ELNs are essentially custom-designed derivatives that combine features of a bond and a call option, allowing the fund to generate income from selling options while still maintaining exposure to the equity market. Unlike traditional covered call funds that directly sell calls on their underlying stocks, JP uses ELNs for efficiency and to manage tax implications more effectively, though the income derived often still falls under ordinary income for tax purposes. Its portfolio typically consists of a diversified basket of large-cap U.S. equities, similar to what you'd find in the S&P 500, alongside these ELNs. This blend allows JP to offer a potentially higher yield than a standard dividend growth fund, often in the 7 to 10% range annually, while aiming for less dramatic swings in its share price compared to growth-oriented equity funds. For an investor starting with $3,000, this could mean an immediate and visible income stream, fostering confidence in their investment journey. However, it's crucial to remember that while JP aims for lower volatility, it's not immune to market downturns. During significant market corrections, the fund's capital value can still decline, even if the monthly distributions continue. Its expense ratio is currently around 0.35%, which is competitive for an actively managed ETF employing complex strategies. The appeal here is its blend of broad market exposure with a dedicated income focus, making it a compelling option for those prioritizing consistent cash flow over aggressive capital appreciation. It's often viewed as a core holding for income-focused portfolios, providing a solid foundation. Kindly consider subscribing to this channel, please, as it costs you nothing to absolutely do so. Also, share with your friends and like the video. Tell us where you are watching from in the comments section. It helps us tailor our next videos to your location. Thank you. Next up, we have JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. If JEPI targets the broader market, JEPQ is its growth-focused counterpart, setting its sights on the dynamic and often more volatile Nasdaq 100 index. This means its underlying holdings are primarily large-cap growth stocks, particularly in the technology sector, that are listed on the Nasdaq. JEPQ employs a similar covered call strategy to JEPI, but instead of broadly diversified equities and ELNs, it directly writes covered calls on individual stocks or the index itself, specifically those within the Nasdaq 100. This provides a way to generate significant monthly income from a segment of the market known more for its rapid capital appreciation than its dividends. The objective here is to capture the growth potential of the Nasdaq while simultaneously generating income from options premiums. Consequently, JEPQ often boasts an even higher distribution yield than JEPI, frequently pushing into the 9 to 12% range. For investors seeking both monthly income and exposure to leading technology and growth companies, JEPQ presents an intriguing option. With a $3,000 investment, the immediate monthly income could be slightly higher, offering more tangible returns in the short term. However, this higher potential income comes with a trade-off: increased volatility. Technology stocks, by their nature, can experience more pronounced price swings. While the covered call strategy aims to temper some of this volatility and provide income during flatter or slightly declining markets, a steep downturn in tech stocks could lead to more significant capital depreciation in JEPQ compared to JEPI. The fund's expense ratio is also around 0.35%, mirroring JEPI's, which is fair for its active management and specialized strategy. JEPQ is suitable for investors who have a higher risk tolerance, believe in the long-term growth of the tech sector, and are primarily motivated by maximizing their monthly income, even if it means navigating greater price fluctuations. Kindly consider subscribing to this channel, please, as it costs you nothing to absolutely do so. Also, share with your friends and like the video. Tell us where you are watching from in the comments section. It helps us tailor our next videos to your location. Thank you. Our third monthly income contender is DIVO, the Nuveen Dividend Growth Covered Call ETF. DIVO takes a slightly different, more balanced approach compared to JEPI and JEPQ. While it also uses a covered call strategy to generate income, its primary focus is on investing in a portfolio of high-quality, dividend-growing companies. The fund's managers are actively selecting companies with a strong history of increasing their dividends, suggesting robust financial health and a commitment to shareholder returns. Only then do they selectively write covered calls on some of these holdings, not all of them, which is a key differentiator. This selective approach allows DIVO to participate more fully in the upside potential of its underlying dividend growth stocks while still generating additional income from options premiums. It aims to achieve a blend of capital appreciation from dividend growth stocks and enhanced income from covered calls. This strategy often results in a slightly lower yield compared to JEPI or JEPQ, typically in the 4 to 6% range, but with the potential for greater long-term capital appreciation and more stable principal value, especially during volatile periods. For our $3,000 investor, this means a more modest but potentially more sustainable monthly income, accompanied by the underlying growth of quality companies. The beauty of DIVO lies in its dual objective. It's not just about chasing the highest yield, but about providing a growing income stream from financially sound companies, buttressed by the covered call premiums. Its active management means it adapts to market conditions, and its expense ratio, while slightly higher than JEPI or JEPQ at around 0.55%, reflects the expertise involved in stock selection and options management. DIVO is particularly attractive for investors who want monthly income but also value capital preservation and steady long-term growth from established companies, making it a potentially less aggressive option than its counterparts.
It's a great choice for those who prioritize a balance between income and growth, aiming for consistent returns over maximum yield. While these monthly income ETFs offer compelling advantages, it's absolutely critical to understand their nuances and potential downsides before diving in. Firstly, let's talk about risk.
Covered call strategies by their nature cap your upside potential. If the underlying stocks surge dramatically, the fund might have to sell them, meaning you miss out on that explosive growth. More importantly, while they generate income, they are not immune to capital depreciation. A significant market downturn will likely see the net asset value of these funds decline, even if distributions continue. Your principal is not guaranteed. Secondly, tax implications are paramount. Income from covered call strategies is often treated as ordinary income for tax purposes, rather than qualified dividends, which are taxed at lower rates. This means your tax bill could be higher if these funds are held in a taxable brokerage account. Always consider holding them in tax-advantaged accounts, like an IRA or Roth IRA, to maximize your net monthly income. Thirdly, total return versus yield is a vital distinction. It's easy to get fixated on a high yield, but what truly matters is the total return, which includes both distributions and any changes in the fund's share price. A fund with a sky-high yield might be eroding its capital, leading to a declining share price over time, which ultimately hurts your overall returns. Always look at the total return performance. Fourthly, diversification is key. While these funds provide diversified exposure within their specific mandates, they shouldn't be your entire portfolio. Consider how they fit into your broader investment strategy. Do you have other growth assets? Bonds? Real estate? A balanced portfolio is resilient. Lastly, pay attention to expense ratios. While JEPI and JEPQ are competitive at 0.35% and DEVO at 0.55%, these fees are deducted annually from your returns. Over decades, even small differences can significantly impact your compounding. For our $3,000 investor, recognizing these points means making informed decisions. Don't just chase the highest yield. Understand the strategy, the risks, and how it aligns with your personal financial goals and tax situation. Monthly income is powerful, but context and careful consideration are non-negotiable for long-term success. These are tools to be wielded thoughtfully. So which of these monthly income ETFs is right for you, or perhaps a combination? If you're looking for broad market exposure with solid income and a focus on managing volatility, JEPI could be your pick. It's a robust option for a core income holding. If you're drawn to the high growth potential of the tech sector and are comfortable with higher volatility in exchange for potentially greater income, JEPQ might be more up your alley, allowing you to tap into the innovation economy with a monthly cash flow. And if you prioritize a balanced approach, seeking monthly income alongside the long-term growth and stability of quality dividend-paying companies with a more selective covered call strategy, then DEVO offers that compelling blend. The beauty is that you don't have to choose just one. Many investors find value in holding a combination of these funds, perhaps weighting them according to their risk tolerance and income needs. For instance, you could allocate a portion to JEPI for stability, a smaller portion to JEPQ for tech exposure, and integrate DEVO for its dividend growth focus. The key is to remember that investing is highly personal. There's no one-size-fits-all solution. Your individual financial situation, risk tolerance, time horizon, and specific income goals should always guide your decisions. Starting with $3,000 is a fantastic first step, but the journey of building wealth and passive income is a marathon, not a sprint. Consistency, understanding, and adaptation are your greatest allies. These ETFs provide powerful pathways to achieving monthly income, but they demand your informed attention and strategic placement within your overall portfolio. They are designed to be income engines, and when properly understood and utilized, they can significantly enhance your financial predictability and freedom. Consider how each fund's unique strategy aligns with your personal objectives. Before you make any investment decisions, take the time to conduct your own thorough research on these ETFs. Dive into their prospectuses, expense ratios, historical total returns, and specific tax implications. Understanding the intricacies will empower you to build a portfolio that truly aligns with your financial aspirations. Share your thoughts in the comments below. Which monthly income ETF are you most interested in, and what's your strategy for building passive income? Your insights could help others on their financial journey.